Every month you check the deposit notification, the number looks right, you move on. The gross figure is the one that made you say yes. Everything below it you have never questioned. Your colleague Dana leans across the desk. HR owes her money. She isn't panicked. She is calm. She reads her payslip every single cycle, every line. You tell yourself you do the same. You don't. That evening you open the payslip PDF. For the first time you actually look at the whole thing. There are 9 rows beneath your gross salary. You recognize 2 of them. 7 are unknown to you. You add them up. $800 is being taken from your account every month, going to places you have never verified. This is where most people close the document. You keep it open. You start reading everything. Your salary runs in 3 layers. The number in your offer letter is only the top one. Total compensation includes money you never receive directly. Your employer's match lives there, locked away. 5% of your gross leaves every month. You called it a tax. It is an investment account. Your employer deposits a match into that same account. Real money in your name. You never noticed it. Your employer deducts federal income tax before the money ever reaches you. They estimate your liability. The estimate is based on your W-4 form. You submitted the default on day 1 and never changed it. 0 adjustments. Your employer assumed maximum liability. They have been overtaxing you since day 1. $300 extra is going to the IRS every single month. Your money, sitting there, earning nothing. You have been lending the government money at 0 interest every month. You called it your paycheck. The next morning, you update your W-4. You adjust the withholding allowances to match your actual liability. Your monthly withholding drops by $300. That money stays in your account going forward. Within 6 months, you are the person on your team who understands this. People come to you now. Your manager asks you to review the compensation structure for a new hire before the offer goes out. You review it in 30 minutes. The housing allowance benefit is sitting in the taxable base salary. Nobody checked. The misclassification costs the incoming hire $2,600 a year in unnecessary taxes. The company is not paying more. 1 line change. The employee keeps what was always theirs. You revise the structure. The offer goes out. A stranger's financial life improves before they walk in. They will never know why their offer is structured that way. They will just keep more of what they earn. You start to see the pay slip differently. It is not a record. Someone built it. It can be rebuilt. Most companies built their structure years ago by copying a template. Nobody has looked at it since. The inefficiencies are not malicious. They are neglectful. Employees absorb them silently every single month. At 29, you move into compensation and benefits. You are now the person who builds the template. The company has 3,000 employees across 4 states. You design the structure for all of them. Each state has its own income tax bracket. Each one interacts differently with federal withholding. You map everyone. The split between taxable salary and pre-tax benefits is your call now. You decide how far the money reaches. A 2-point shift from taxable salary into pre-tax benefits changes 400 people's monthly pay, $100 more per person per month. That money stays in their account instead of going to withholding. $40,000 a month is staying in household accounts. You did this with a spreadsheet and a memo. At 32, a manufacturing company calls. 800 employees, scaling to 2,500. Their payroll structure has not been audited in 5 years. You review it in 1 sitting. $500 a month labeled general compensation. It qualifies as a pre-tax benefit. Nobody checked. Restructured as commuter and dependent care benefits. It is partially or fully exempt under IRS rules. The misclassification is not intentional.
It was never malicious. No one checked. That is the whole story. Across the full employee pool, the excess tax liability is over $1.2 million every year. You sign the consulting engagement before lunch. The knowledge that started on a Tuesday night pays now. The restructuring takes 6 months across multiple payroll cycles. You track every band, every state. The employees never see a memo about it, no announcement, no town hall. Nothing is communicated publicly. Employees notice their take-home pay went up and their W-2s shrank. Most of them never ask why. You know why. You built it. The work is silent and invisible. That is exactly what makes it permanent. You are not creating loopholes. Every exemption you use is in the IRS code, available to anyone organized enough. You close the gap between what employees are legally entitled to keep and what they actually keep. The document was always available. The information was always there. Most people simply chose not to read it. Then the IRS issues a guidance update in the spring. You read the language twice. It is not settled. It tightens the treatment of bundled pre-tax benefit classifications. Narrow reading, your structures hold. 11 active client payrolls depend on the old treatment. All 11. You pull up the list. You bring in tax counsel that evening. You need a formal legal opinion before you can move on to any of them. The opinion comes back split. Defensible position, real litigation risk. Depends on the examining agent. You present the risk to 3 CFOs in the same week. Same data, same opinion. Each room responds differently. You give them the cost to defend and the cost to restructure. You hand them the number. You stop there. 2 of the 3 restructure immediately. The third decides to hold the position and accept the exposure. You don't know yet who made the right call. Neither do they. The assessment window has not opened. This is when you understand. The system always pushes back. It moves on its own schedule, not yours. Tax law changes, guidance updates, assessments open. Every structure you build has an expiry you cannot predict. You can optimize inside the current rules. You cannot control when those rules are rewritten above you. You are well compensated now, influential, but you are not safe. Those 2 things will always be true. Every quarter, you read the new IRS guidance. Every budget cycle, you check the proposed changes. Still, as your work expands, your network shrinks. Fewer people operate at this level. You feel the distance. Somewhere tonight, a 23-year-old is staring at the same 9 rows you ignored for 3 months. They will update their W-4, fix the withholding, ask the question nobody around them is asking yet. Those questions compound the same way capital does. Slowly at first. Then, in ways that change everything downstream. The payslip was never just a record. It is a map of every claim the system makes on you before you are paid. Some of those claims are fixed. Some are negotiable. None of them disappears by ignoring the document. Tomorrow, another payroll cycle runs. Another guidance memo is being drafted somewhere. Another person opens their payslip. The ones who do well are the ones who opened the document and refused to look away. You never looked away.